This is Richard Flax at Moneyfarm, talking about some of the things that have caught our attention over the past few days. Firstly, on the macro side, we've seen some decent manufacturing survey data from the US, new orders in particular, well ahead of expectations. And that gives us some comfort that the recovery is gradual but on track. The unemployment data was a little less clear. The headline number looked better than expectations, but there was a change in methodology which makes comparisons a bit more difficult. In the Eurozone, the manufacturing data was also a little bit less clear. Results in Germany were a little bit ahead of expectations, but elsewhere it was a little bit weaker. So when we think about the outlook, so far the US looks okay. The Eurozone, after an initial strong bounce back, the data is a little bit more uncertain, but it's something we'll continue to monitor closely over the coming months. In terms of financial markets, we saw a pickup in volatility over the past couple of days, and it's really highlighting the extent to which the recovery, particularly in the US equity market, has been driven by a relatively small number of large tech stocks. And some of that reflects the changes in consumer behavior that we've seen over the past few months, with an accelerating move towards digitalization, online shopping, etc., etc. And the question there is really not only how sustainable that will be, but really as the recovery hopefully broadens, will we see some of that filter down towards the other 495 companies in the S&P? Or will we see it remain relatively concentrated within a small number of fast-growing businesses? And what you would hope is that as you see the recovery broaden, so you see a broader range of companies and a broader range of stocks begin to benefit. But it's also important to recognize that this isn't just a 2020 phenomenon. So-called growth stocks have been outperforming so-called value stocks for a number of years, and that has really only accelerated over the course of this year. And lastly, turning to the UK, the Brexit negotiations are coming back increasingly into the spotlight, and the news so far is not particularly good. The tone on both sides is quite negative. It's important to bear in mind this may simply be a negotiating tactic on both parties' side. But it's important to remember as we come towards the end of the year that the current lack of clarity on the relationship between the UK and the EU makes life more difficult, potentially for particularly UK assets. And when we think about it from a portfolio construction perspective, we don't have a very strong home country bias within our UK portfolios, and that geographic diversification is something that has benefited us, and we think will potentially continue to be a benefit as we enter a period of heightened uncertainty. Thank you very much for joining us, and look forward to speaking to you again soon.